to a reserve deduction. So you're going to get clobbered on both sides. You know, it's 35% on the payor side, 35% on the payee side. You know, that's 70%, put on 20% penalty, so that's 14 more percent. So that's 84% before you got interest. You know, after a while, you can't really make too much money at that.
Go backwards.
If the government's going to take 84% of it. So that's, we'll see what happens. I don't think personally that they can do that. I think it's contrary to their revenue rulings, but they don't think that. FBAR we talked about earlier today. So unless somebody has a question about that.
On FBAR?
And so this is the time of the presentation that I've been waiting for, because Gary, and I know Gary Osborne's been waiting for it, because Gary Bowers is going to tell us all about this thing called FATCA. Is that the Foreign Account Tax Compliance Act?
It's the Foreign Account Tax Compliance, which was part of the Hiring Incentive Reduction in Employment Act in 2010. And what they're trying
I don't think we really want a reduction in employment.
Well, that was the name of the act, so at any rate, the purpose of this is to attempt to gather information on U.S. businesses and individuals that have offshore and foreign investments. You know, we've all heard about the HSBC case and some of the other things going on, and the government, Congress, everybody believes there's an awful lot of money being held offshore and not being reported. So FATCA was enacted with an attempt to try to capture all of that information so that they can then go after tax evaders. Now, where it comes about, and most of this related to captives, and I'll talk about captives first, individuals that actually kicked in 2011, and you had some reporting requirements you were supposed to do if you had interest in foreign entities that are in addition and in excess of the FUBAR stuff, FBAR stuff we talked about. Captives are included in FATCA by regulation, not by statute. That's very important. They were never, the intent of the law was not to go after captive insurance companies or insurance companies in general. It was to go after other things. Regulations, there's a concerted effort somewhere in the service, and it goes back to some of this that we were talking about with increased activity in examinations. They're wanting to know about these captive insurance arrangements, where they're located, what are they doing, how many of them are treating themselves as non-CFCs when maybe they really aren't non-CFCs, how many are reporting and doing the types of things that they're really required to. Now, the biggest thing that deals with FATCA is something called FFIs, Foreign Financial Institutions, banks, investment houses, those types of things were what they were after. It's been expanded, as I said, under the regulations to include any insurance company that writes a type of cash value product, be it life insurance, a type of annuity. Those are going to be considered to be FFIs. And FFIs, you've got a whole myriad of things that have to be done as regards to trying to prevent withholding, prevent information requests on a quarterly basis having to go to the service. Now, the good news to all of that is the majority, or probably 95% of our captives, are not going to be affected by that.